All right, you guys, this is being recorded, and I mentioned this at the beginning of every single webinar. Watch it again. Maybe not this exact short straddle video, but watch one of the other ones too, or this one. It doesn't matter, because some of the nuances are going to go by you. I have specific rules that I like to set up to increase your probabilities of success when using any strategy. And that goes as well for this one, all right? So yes, the straddle is probably one of the easiest option strategies to set up. You can find out how to do it online, right? Yes, you're selling the same strikes at the money. That's easy. You guys can leave. No. I have rules around this, and I'm going to explain why my rules are there and why we should follow those as we go throughout this. It will obviously, or it will absolutely increase your probabilities of success. But I want to go through it with the assumption we just have a market neutral bias. We don't necessarily know that we are going to be doing a short straddle. We could be using anything or many strategies, but we're going to be looking at, we have a market neutral bias and what strategy goes best with that. And we're going to kind of fill it out that way. So think about that as we're going along. We're looking at a market neutral strategy. We don't necessarily know the actual option strategy just yet. Anyway, this is me. You guys may recognize me from CNBC or Fox Business, maybe even the Wall Street Journal for different kinds of commentary, whether it's geopolitical, market analysis, or economic stuff. I'm not going to make you guys rich or make you a millionaire, most likely, unless you're already a millionaire. But I am going to help you take control of your finances, increase your probabilities of success with this stuff, right? If you're doing stocks, your probabilities of success is 50-50 or anything else. But I'm going to move those probabilities into your favor by setting these up when it's optimal, all right? I've traded in most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. And any opinions, news, research, and analysis, other information should be considered market commentary and not considered investment advice, you guys. I'm not here to give you guys stocks and just go out there willy-nilly and stick it into your portfolio. I don't know what's in your portfolio. I don't know what's appropriate for you according to your risk parameters. So all of those things need to be taken into account on your own, and make sure you do your own homework. And past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat for any kind of market wisdom and or snark coming out of me from any given thing. All right, like I said, we're doing this on the short straddle. I'm going to go over a couple of things, but let's pretend as we go along here, we don't really necessarily know we have the short straddle that we're going to be doing. And the short straddle is pretty simple setup. We're going to be selling an at-the-money call and an at-the-money put, and these strikes are going to be the same, all right? So these are going to be the same strikes, same option strikes, all right? Pretty easy. All right, so same option strikes. It's going to look like this. As a matter of fact, you know, we're going to have to nail the number on this. So like this underlying, the stock needs to trade right at 40 to get the max profit on this straddle. There is unlimited risk in either direction as well. This will continue to, you know, stretch out as they go down. This will only go to 0. But at the end of the day, we've got to nail this number, which is a pretty hard task. You know, that's why a lot of people don't like playing with the straddle, is it feels like you've got to know the exact number. You don't. We are going to show you how we set this up with high probabilities. We aren't going to try and nail the number. We're going to be trying to get out of this relatively easy, all right, or relatively soon. But we need to go over these rules to make sure that we are online or on task, okay? Picking the right underlying. This is the first thing. We have a market neutral assumption on a particular stock. Well, we need to know if we can trade options around this underlying. We've got Caterpillar up here. I'll just use it as an example. So any stock that is over $100, we need to move the decimal place 3 ticks to the left. 1, 2, 3. I'll just go like this. 1, 2, 3. So we move it 3 ticks to the left. We've got 13 cents, right? You can basically say somewhere between 13 and 14 cents on this strategy. So we're looking at 14 cents, and that's how wide we should see the bid to the offer on these options that are the spot month. This is the one that's going to have the most time and volume traded. This is where the most eyeballs are. So that's where we want to look for this rule. And 14 cents between the bid offer, you can see that this fits that rule even after the market has closed for Caterpillar. Now, this rule is typically, we're only going to look at this rule during open market operations where there's a lot of different eyeballs and participation. Think about it. We're going into a holiday weekend here in the United States. People are canceling their orders. They're not going to ride that out over the weekend and forget about them. Same thing goes for you and I when we're trading. I usually put mine in for just a day trade, and after the market closes, they automatically get canceled. It's not being reflected in the market when the market is closed. So make sure this rule, picking the right underlying, any stock over $100. So if it's greater than $100, I don't know why my pin doesn't want to work over here. So if it's greater than $100, then we are going to move the decimal like I showed over here. If it is less than $100, our rule is it needs to be less than 10 cents wide, all right? So if it's less than $100, we're looking at less than 10 cents wide on these bidder offers, just out of the money on the option contract that is the spot month. You know, you could even look at the 16. Some people could say that there's a lot of participation in the one that this monthly here with only 16 days to go, but I would argue that and say that people are already starting to look out here. That would be where I would first look, because that's where we're probably going to be getting into our trades, right? So over $100, move the decimal 3 ticks to the left. Less than $100, we're looking at 10 cents wide to the bid offer for our stock, okay? So that would be the right underlying. That would mean we can trade options around it. You know, there's stocks out there everybody's heard of, like Aon and stuff like that, where it doesn't follow that rule, all right? So follow that rule, especially if you are newer to options trading. If you're savvy, you know, there's a couple of stocks out there that I was looking at, you know, I mean, like Cummins, CMI doesn't really follow that rule, but I trade it a lot. And I know that if I put in an offer a little bit away from mid-market, I'm probably going to be able to get filled in there, because there's people watching that market that are in the weeds. And it's only a couple of pennies off of my rule. I think it's like, you know, it's a $170 stock. And so 17 cents is my rule for that. And it's about 20, okay? 20 cents wide for CMI. I bend that rule for that one, but note that when I look at it, I'm looking at this as, you know, the stoplights. We got a green light, all right, a yellow light, which is what that would have been on that Cummins example, where it's a little bit wider than what I was talking about, and then you got your red lights. You know, if you get one yellow light, I'd say that's okay. You definitely want the green lights. If you get any red lights on there, though, I would say that that would be a no-go, all right? So, you know, if you were looking at a $150 stock, my rule says 15 cents, and it's 30 cents wide, that's where I would start saying it's a little bit too wide. You know, Cummins, if they were, you know, 30 cents wide, then I would say don't trade Cummins. But it only bends my rule by about 3 cents. You know, what is that? 2% or something like that. That we don't really have to worry about it too much. Okay. So if you get too many yellow lights, walk away from it. There's a better option strategy out there. And if you are getting red lights, just stay away from it in general. Oh, so let's talk about the environment though. So environment, we talked about the underlying less than 10 cents wide on a $100 or less stock. On the environment, we want this to have high implied volatility. Where did that come from? High implied volatility, IV%. I don't know if my finger's touching something or what's happening with my marker today. But we want high IV%, all right? HIGH. That's what I look like when I try and right with my mouse. So we want high implied volatility percent. Anything above 50 for a stock is what we're looking for. Anything above 30 for an ETF is what we're looking for. All right. So when we're over here looking at this stuff, Caterpillar, I'm not looking at this volatility number over here. I'm not looking at the chart and looking at this volatility here, other than I want to look at Caterpillar's implied volatility of 25 and look at where it is in relation to where it's been in the past, because every underlying has its own implied volatility percent, you guys. So, or sorry, has its own implied volatility. For instance, Tesla is going to have extreme high volatility all of the time. But what we need to know is where that volatility is right now in relation to where it's been in the past. Because just like a stock like this one here, Caterpillar, you can see that there's ranges that it usually wants to stay in. Yeah, you get your breakouts here, maybe a breakout a little bit lower than normal. Same thing here. You can see that, you know, it usually wants to trade kind of within those areas. You get those little breakouts. But for the most part, we are contained within a certain range. And what we want to know is where we are now in relation to where it's been in the past, okay? That just gives us a good idea as to we're comparing apples to apples that way. We can see that 25 is in the lower extreme area of this chart, right? But when we want to find out the implied volatility percent, what we need to know is three things. We need to know the low, which is 19, and we need to know the high, which is 54. The current is 25. So we have, I want to make sure I got that. What was the low? Is 19. The high is 54. So we have a fraction here for implied volatility percent. We take the current minus the low and divide that sum by the high minus the low. So we've, in that sum. I don't know why that's doing that, you guys. I'm sorry. So the current minus the low, and then the high minus the low. And then we're going to divide those by each other. So we have the current, which is 25, minus the low of 19. And then we take that sum and divide it by the high, which was, I think, 54 now. 54 minus 19. All right. So now we have 6 divided by 25. No, sorry, 35. Ooh, sorry. Divided by 35. So that is in 6 goes into 6 divided by 35 puts us at the, what is that? That's probably close to the 20 percentile or something. Did I do that right? I'm going to have to pull out my calculator. My brain's not doing that math for me right now. I'm thinking of too many things, I guess. Where is my thing at? Where are you? Oh, it's behind here. All right, so let's just do it this way. 6 divided by 25, or sorry, 6 divided by 24. 6 divided by, somebody else has got it. I see somebody popping it up there. 6 divided by 35. 17%. So 17 percentile. So that tells us right now we're in the lower portion. I said we need to be above 50 for this kind of trade. But one of the things I want to show you real quick is we're looking at Caterpillar here. I want to look at something like GLD. All right. So GLD has that right around that same kind of IV percent, right? The low on Caterpillar was 15-ish, right? Not even maybe. The low was probably closer to 19. And then we're looking at this going down all the way to like 8. So if we just look at the implied volatility of gold, you might say, well, you know, it's only 15 and Caterpillar was 26 or something like that. So Caterpillar's got higher implied volatility. I need to sell premium in Caterpillar and not gold. No, that's not true. What we would want to do is sell premium in gold and not Caterpillar. We would be buying premium in Caterpillar because Caterpillar's implied volatility right now is really low in comparison to what it's been in the past. All right. So we have expect volatility to revert back to the mean and kind of stay in its happy place, which is usually middle of the road. So we would expect gold to come off and maybe Caterpillar to start seeing more volatility, all right? So we need to compare where each individual underlying's current implied volatility is in relation to where it's been in the past, because they have those boundaries that they usually kind of stay in, all right? So that's why it's important to come up with that implied volatility percent, because we know then if it's high implied volatility percent, then these premiums are at their greatest that we've seen in a while, right? So in this regard, we would be wanting to sell maybe the straddle in gold and then buy the straddle in Caterpillar, expecting that to expand. But we can see that Caterpillar, even though they're like priced at the same area, right? GLD is 133.60 and Caterpillar is 134. So, you know, if you're comparing apples to apples, you would say that, well, this is where I'm talking about. Look at these premiums right here at the money that we would be selling for the straddle. Well, it looks like you're getting a lot of bang for your buck compared to GLD, but remember, this is really low implied volatility. So if this volatility was, you know, in the upper band at like 80 percentile, these would probably be almost doubled, okay, where they're at. And then that's when we would want to be looking to sell premiums. But right now, with Caterpillar having this low of implied volatility, yeah, it looks like it's a juicy trade, but if volatility starts expanding on us, that's going to hurt us, right? Because as volatility expands, as this number increases every 1%, then these premiums increase by, if this went from 26.77 to 27.77, these premiums are going to go from $2.40, I'm just going middle of the market, to $2.58. That's meaning this underlying did not move what one tick up or down, 1 penny up or down, all right? It didn't move. The day didn't change, like the hour didn't change. There's no time decay coming out of this. I'm just speaking about this going from 26.77 to 27.77. This goes up by that 18 cents, all right? So you can imagine if Caterpillar is only in the 16th percentile, you know, and we go down here and look at this chart, well, we could see it's at 25. Well, what if it just went up to 40? That's 15 percentile difference, right? 25 to 40, we've got 15 percentile difference. Well, you could take 15 times that 18 cents in Vega, and you're having almost a $2.50 increase, right? That's just off the top of my head math, but that much of an increase back to the middle of the road would increase just this one premium. These premiums are going to increase by that equal amount as well over on this side. The Vega is 19. So, you know, it'd be 20 times that, what did I say, 15% increase. So, you know, you're having $3 increase almost, actually. So that's why it's important. We need to make sure we're setting this up in the correct environment. And for this, we're looking for an implied volatility percent to be above 50 for stocks, right? And then we also, so we want it to be greater than 50% for stocks and greater than 30, this is for stock, and greater than 30% for an ETF. All right, so like that gold. When it gets above 30, yeah, it's at 80. We don't ever know when it's at its extreme highs, but once it starts getting above 50, that's where we know we are, you know, above where it wants to be. It wants to be at the medium, it wants to be right there at 50. The ETFs want to usually stay relatively suppressed. And that's because there's a basket of over 25 stocks in this ETF where all of those implied volatilities are going to meld out the ETF. So it's going to have a tendency to be suppressed for a greater amount of time, all right? It'll get those spikes like we're seeing in gold or the junior gold miners or the major gold miners. We're seeing those spikes in those right now. But once the market starts settling down, that volatility comes out of those ETFs really fast. So that's why we want to set it up when it's an ETF above 30 or a stock, it's above an IV percent of 50. All right. That's when we start looking to, when we start seeing this above 50 and above 30, that's when we know we are looking at short or we're looking at credit spreads. All right. We're looking to get a credit for our trade, because if you sell it when those premiums are, pumped up, overinflated, then when that volatility comes out, that's when you actually will see you make your money on this trade rather than holding on to it for a long time. A lot of people think when you're doing a credit spread, all you're doing is waiting for theta to eat away at our premiums. Well, on the floor, we used to call theta the thief in the night, but really vol is the thing that is going to make us money on any type of credit spread. You have that high vol, it comes out. Just like I showed you in that previous example, if Caterpillar had that volatility increase on us, what it would do to those premiums. Well, think about it when the other direction, like for instance here, you wouldn't have been in this trade for very long if you had gotten it up at some of these higher implied volatilities, but look how fast that volatility came out. I mean, it went from, a 47 to, let's just say, down to, 37. Call me crazy, but $2 of premium when this isn't really going a whole lot of direction, it's not really moving a whole lot. Yeah, it looks like it's kind of juking back and forth, but that volatility coming out right in this area right here, we could be directionally wrong. Our market neutral stance might not be working out, but oh my gosh, we got that volatility crush. That's, in just a matter of a few days, that theta decay is not going to help you out, but that volatility coming out right now is really what's going to make us get to our profit target much quicker. So volatility, when you're dealing with a straddle, is probably the major component you're going to be looking at, okay? Especially when you are dealing with different stocks. Make sure you're looking at the implied volatility percent, not just the implied volatility, okay? Because this number over here tells you nothing, right? All it tells you is where volatility is right now. It doesn't give you a gauge as to where this XYZ's volatility normally is. And that's what we need to find out by doing that, all right? And then picking the right duration. Picking the right duration, anytime we are doing a credit spread, right? When we're looking at a credit spread and we have really high IV percent, right? So these two things right here, the underlying, the environment, all of these things are starting to narrow us down. Like this all of a sudden told us that the environment is high IV. We've got that figured out for this strategy. That's what we're assuming, right? We're going through this. We looked at XYZ. I've got a market neutral assumption on it. Yes. Okay. I can trade options around it. What's the environment around it? All of a sudden you see XYZ has high implied volatility percent, above 50. All right. Well, now you're looking at a credit spread. Well, if we're looking at a credit spread, what's the duration? Some of you guys, I know some of you guys have been here for a couple of these webinars. You probably should know this. That's right. If you are looking at this, we're looking at trying to get as close to 35 days to expiration as we can get. All right. Closer to 35 days is better. You go inside of 35 days, you will see this volatility, this theta component happening. Okay. Inside of 35 days to expiration, we've got right here. You can see that theta is very slow to come out of our premiums. But once we get inside of 35 days, there is a 50% drop in those premiums coming in. So in those examples I was showing you, just the theta decay component for 35 days to the next, 28 days or something? 28 days. These 28 days, you get a 50% drop in your premium. That's what we want to take advantage of. The other thing is we're looking at getting into this when there's high implied volatility. And what that does is it kind of pushes this curve out a little bit. That volatility pumps up those premiums. So when the volatility comes out, it wants to rush to catch up to the curve, right? And this is all premium coming out to the drop. And we've also got the theta decay. So we've got both of those things working in our favor when we do this. We obviously don't want to get into it right here and volatility expands on us because that's going to hold off and premiums are going to go higher. So we want to get in when we have high implied volatility. Yes, it could go like that and then come back down, but we know we're setting ourselves up for success when we've set it up appropriately. And doing that, all we can do is say, hey, implied volatility is high right now. That's the time to be selling premium, all right? Volatility comes out, you can get out of these strategies quick. All right? And picking the right strikes, this is pretty easy, right? We don't have a whole lot to think about this. But my thing here is try to get about as delta neutral as you can, right? Our underlying is neutral. So we want to try and get delta neutral. All right, so that's our goal. It's not ever going to really work out to be perfect, but you want to try and shoot for as close to delta neutral as you can because you have a neutral assumption. Now, if you thought, I have a neutral assumption, but XYZ is trading right here, and I think it's going to come maybe to this spot and kind of settle down, which is maybe a tick lower than the at the monies. Maybe these are the at the monies. And you thought it would go a little bit lower, maybe a tick. Well, yeah, you can do that here, but then no, you are going to have a slightly negative delta bias, all right? So you're going to need the market to come down just a little bit for you. But I have no problem with doing that. And, if you did on the calls out of the money up here, just know that you're going to have a positive delta bias, all right? And I'll show you all that here in just a second when we pull that up. As a matter of fact, here, I'll pull this up right now if I can find my platform. So let's just take a look at GLD because we see it's at the highest range we've seen in quite some time. And obviously it doesn't mean it's going to come out all at once either. I mean, I've been selling some GLD and GDXJ and stuff. So I've been trying to take advantage of it as well. All right, so picking the right strikes. This is what I'm talking about, delta neutral. When you look over here at the deltas, the ones that are closest to the at the money are going to be the 134s. You can see that if I sell this one, you sell a positive, that makes this a negative, right? So selling a positive delta makes it a negative. So we were negative 51 deltas. And then we sell a negative, that makes it a positive. We have positive 49 deltas, right? If I'm looking at the same strikes, we got 49 positive deltas. So we would be slightly negative delta on this, all right? It would mean we have a slightly negative bias on that. So just try and get them as, now I would say that's as close to delta neutral as you can get. If you went to the ones that are in the money a little bit, like I thought it was going to go down to, 133, then I'm okay with that, you guys. Just make sure you got the high implied volatility for that. You can play around with these premiums. I don't have a specific amount of premium you've got to collect for this because we just know that when implied volatility percent is at highs or near highs, that's about as much as you're ever going to get for that strike, okay? You just know that. If volatility is at its highest at 100%, like for crude oil here, that's at the highest we've seen, all right? So you can rest assured, yes, it can continue to go higher, and that's a product of this. If volatility continue to go higher with this oil CL, then it would still be 100%. So it's kind of a little deceiving. You would say, oh my God, it's at 100%. It's never going to go higher than that. Well, yes, if it upticks again, it's still at 100%. All right. So that's one of the bad things about this math. There's no real way around it, but just you got to know that if it's at 100%, it can continue to be at 100% if volatility goes higher. Same thing if it's at 0 and it goes lower, it continue to go lower, that's still 0. But try and build this out to be as close to delta neutral as you can, because that keeps your market assumption neutral. All right. And then knowing our exit strategy before entering a trade, we're looking for 30 to 50% of max profit. All right. 30% is usually what I do for the straddle. And I have a pretty high risk tolerance. I will go for 50% sometimes, depending on, how sure I am of my, feeling with this underlying being, market neutral. But usually a 30% is good. You're going to still get a really good return with that, because think about it. The straddle gets you the most money of any option strategy. Okay. And no, that doesn't mean that we're necessarily increasing our risk. When you have that amount of money, you are basically getting almost very close to that one standard deviation move. So you get a nice chunky premium, but it gets you a nice move in either direction that you are going to be safe. So yes, it is a little scary, but I'll show you when we're building this out how much wiggle room you have. All right, and like the strangle, I have a couple of little rules, especially if you are newer to options trading. When to exit. We're looking at this. If you are in this, these are days to expiration, all right? And if you're in it less than, that's greater than, isn't it? If you are in this for less than 10 days, then you're going to be looking at the corresponding, so this is, let me go over this again. This is days to expiration, and less than 10 days to expiration, and you're at 10% of max profit, then I would look to cover this, especially if you're newer with this strategy. All right. So, you're looking at, if you collected $4 for this, you're going to be looking at getting out when it's trading around, $3.40 or $3.60 or something. 15 days in it, less than 15 days in it, you're looking at 20% of max profit. Less than 25 days, 30%. And usually that's going to be where most people probably look to get out. And if you're in it for less than 35 days, get out for that 50%. And I would say get out for this 50% no matter what, right? You could see this 50% happen in less than, 10 days as well. You get that volatility, you get IV coming out. That's going to get us to that point much quicker, right? So I've been in straddles less than 10 days and gotten out for 50% of max profit because of that volatility crush happening, right? All right, so what's our max profit? Anytime we're collecting a commission, it is the premium received, all right? So that's why it's important to get the most amount of premium we can, all right? Max loss, we've got two possibilities. They can't both happen, right? The market can't go in both directions at one time, but we do have two loss scenarios, all right? When the underlying price is greater than the short call plus the premium. Remember, when you're getting a credit, that increases our reward area in a sense. So when you get a credit on the call side, you're going to add it in. It's a plus, right? On the put side, you're going to subtract from that put side the premium. All right. So it gives us wiggle room lower than our short put strike and wiggle room above our short call strike. So it's not, your risk isn't right there at the money. All right. And it's the total premium. All right. It's not just the short put premium or the short call premium. It's the total premium you collected. And then our break even is going to be when the short call strike plus that premium all right, or the short put price minus the premium. This is when it's 1 penny past that break even, right? That's when you start feeling that loss. Is what I was trying to say there, I guess. All right, so I'm going to pull up the platform. You guys throw out some stocks you want me to look at. We'll go through it. Come up with a market neutral assumption. We'll go through the steps and see if that if it follows through with my rules. In the meantime, I'm just going to go with gold because I know it's got high implied volatility percent. Let's just say I've got a market neutral assumption. I believe that volatility, or that it's going to stay maybe within, let's just say I think it's going to stay within here and, you know, somewhere up here. Let's just say that's 140. I do not know where that is coming from, you guys. I don't know how it's remembering that. So, you know, above there for sure, but I want to be above here. I want my break even there, and then I want my break even maybe up at around 140 or something like that. Okay. I'm just saying that number because somebody's asking where did I come up with that number? Well, I figure I want to be below here from where we're trading, which is from 32 to 28, so about 15, and I just added 15 onto the upside around that, from where I probably should go a little bit higher than that. But that's where I kind of want to shoot for my break evens. 130 to 140 is where I'm thinking is appropriate. 130 to 140. So let's go in here. I'm going GLD. I've got a market neutral assumption. 3 ticks to the left. Does that fit that rule? Yes, that fits the rule. So I can trade GLD options. I'm going to go closest to 44 days to expiration. That's part of my rule, right? Now, implied volatility percent, I said it's above 50 for an ETF above 30. This is an ETF. I'm well above 30. As a matter of fact, I can go over here to the chart and see that we haven't been at this level in 52 weeks. So that's still great. So I'm going to go in. What's the closest to, you know, it's almost a pick 'em, but I'm going to go with the 134s, sell those and slide it down. Come on. 134, sell that one there. Put that away. So $5.48. Let's just take a look at this on the Analyze tab. So we can take a look at it. Oops, can't send that. I want to Analyze. So Analyze the trade. And you can see it's very similar to what we were looking at in the other one. Obviously, this is going to continue to go down. Get rid of the butterfly. That continues to go down to 0. This will continue to go down to, if this goes to infinity, it will continue to go as a loser. All right. If you guys are doing this in an IRA, pick the first option strike that you can buy for a nickel. So if it's, 3 cents at 6 cents, you're trying to buy it for a nickel right in between. All right. So try and define that risk to trick the people who write the rules. All right, so we can see our max profit is $5.48. I would be getting out of this at $2.70, or figure it out. 30% of that is going to be at when it's trading at about $3. So $3 would be a good place to get out of this one, somewhere at $3.25 or something. All right. So we know where we're looking to get out. Now, our break evens, we add that $5 in, it takes me to 130, 140 almost, right? 139.48. And to the downside, I subtract that and it gets me below 129-ish. So that's right in line where I was talking about. My break even is like right around in here. My break even up there about 140. If gold starts pinging back and forth right in here, then I'm good, right? That's a long move. And if we can take a look back at this, if I added that back in, I'm going to round it, all right, just to make life easy. If I add that back in and we go to the 140 strike, we can see that 140 strike is a 24 delta, all right? Very close to the one standard deviation. The one standard deviation is a couple dollars higher, but almost to where we were when we were selling the Strangle. Remember, if you guys, last week, we were talking about the Strangle, doing the 16 delta. This one gets us 2 strikes inside of that. So when we're talking about market neutral, remember how we've been going along with these webinars. I started out with like bullish to market neutral, and then we went market neutral, right? Closer and closer to market neutral. Now we're like really market neutral. We really think that we have a good inclination that gold is going to be sticking right here, okay? Yes, we're going to get a lot more money for this strategy than we would with the Strangle. And we are probably getting out, even at 30% of max profit at a much better collection on that, a much better winner than we would with the Straddle as well. All right. So if you're a little less sure about your market neutral stance, then maybe go to the Strangle. But if you're a little bit more sure, I think it's going to sit here and we're going to pin to this number or very close to it within a certain amount of range, certain amount of wiggle room. This would be the strategy to do it because it gets us, $5 higher and $5 lower. That's a great move. I mean, that would be a big move in gold. It's possible right now. People are saying it's very volatile. Why would I want to do it when it's really volatile? Because we expect volatility to usually come out as quickly as it came in. So volatility came into this market quickly. We would expect it to come out quickly. You can see when it rallies up, it comes out almost as quick as it came in. So that's why I'm willing to hold on with this and play around with it. So that one would work. All right. Somebody else threw out Amazon. I see your question. Hold on a second real quick. Let's look at Amazon for the rules. So Amazon's the one I think I'm market neutral in. I look at the stock, move it 3 ticks to the left, $1.90. We need to make sure that these are inside of $1.90. You can see they're about inside of $1. So that fits that rule. That means there's a lot of eyeballs in here. There's a lot of participation. The next thing I want to do is look at the closest 35 days to expiration. That would be these 44 days to expiration. Then I need to go and say, what's the implied volatility percent? Well, it's pretty low. So that's really low for Amazon. This would be something I would be looking for premium buying because as low as it's been for this extended period of time, I would have to expect that volatility would start to expand. So therefore, with Amazon, if I had a market neutral assumption, then I would probably look to try and do something else other than a premium selling strategy. And those are hard to come by when you don't expect it to move at all. Okay, not waiting for expiration because up or down $5 is the expected move. Yes, well, and great point, and I'm glad you brought that up. I meant to mention that, and I think I've forgotten to talk about that in the last couple of webinars for this. So thank you for doing that. So the expected move, Banu is coming up with the Straddle at 80%, right? I believe. So Banu knows my little trick on the expected move for this, and you take that expected move. It's actually 80% of the Straddle, so it's going to be less than that. The expected move is going to be, the volatility is saying it's plus or minus $5, so we can go with that. So it's a little bit more than what they're going with there. Our market maker move, it's really less than that, to be quite honest, is $4.48 times 80. And so $4.38 is really the market maker move on this. So we're going to be inside of that. So that's a good thing. It's obviously always going to be inside of that with that rule. This is saying it's, plus or minus $5. Yeah, we're plus or minus $5. So we're inside of that. As soon as this volatility starts coming out, though, 1%, this is going to start down ticking as well. All right. We just know we're getting in when it's high volatility. That volatility starts coming out. We're going to start making our return much quicker, right? Because right now, if volatility came out 1%, we're losing almost 40 cents for every 1% downtick. That's a lot of money, right? So that's why we want to do it with high volatility. We get paid when the volatility comes out. Does anybody else have any other questions about that comparison with GLD and Caterpillar? I want to make sure everybody's clear concept on that. Does that make sense on how I compared GLD's high volatility, even though it's lower than what Caterpillar's at currently? All right, good. Yeah, because Caterpillar is really low, but if you just looked at this number over here, one might say it's high, depending on what you're comparing it to. If you're comparing this to Tesla, 25 is where we currently are. Tesla never gets below 25, right? So you can't even compare Tesla's 61 to its to anything else. 61 is actually pretty low, or is relatively low for Tesla. So that's why we need to do that math. Where is Tesla normally at? Where is it high? Where is it low? Where are we in relation to those? Okay. And it's a good thing to know that equation, because sometimes like drug stocks will get these huge spikes when they have a drug trial result, and you know, that's an anomaly. That might not happen for another 5 years or something. So do that math. You can discount that because they're probably not having another trial within a year, and figure out if it's high or low for itself. All right. All right. Well, then without further ado, you guys, we've got this offer for you. You're going to have to punch it into your URL or go over to the chat window. I'm putting it into the chat window right now. That is a hot link. It'll send you right there. This is a multi-course deal here. So you guys will be able to get all of these 4 courses for $297. This is our Brexit 1776 deal. So regularly it's, you know, if you bought all these individually, it's going to cost you closer to $4,000. But all of them, you get the Volatility Crush, which never gets a discount. This one is a great one. You're going to be able to understand volatility a little bit better than even what I've explained so far. The Trader Hacks for Options, this is going to streamline your process, all right? This Volatility Crush is going to help you sleep at night. The Trader Hacks for Options is going to streamline your process. Like some of those things I've talked about with probabilities, I'm going into 5 or 6 different things you can come up with for Delta. What it tells you, those are floor trader hacks that you don't have to go through the math and all of that stuff. You'll be able to figure out all this stuff a little bit quicker. The history of options, how we came up with all of this stuff, how the pricing's done. You can get really dig down on options and those components within those options, and then how to trade those options. All of the strategies I've taught and my rules, like we've talked about, going through those, leading you to the right option strategy. So all of that will probably take you a year to get through, because I think there's, I don't even know how many hours in each one of those, but it's a lot. For $297. If you guys have liked how I teach, yes, like I said, you can go online right now and figure out how to do the straddle, right? Anybody can tell you how to do a short straddle. It's those 2 at the money options, right? At the monies, you can tell when I'm writing with a cursor or a mouse, right? The at the monies, yes, you can do it, but they aren't going to tell you how to get out of this strategy. They're not going to tell you what the implied volatility is. And all these other strategies, they're not going to tell you the strike locations. They're just going to be like, for the strangle, just sell the out of the monies, right? I give you strike locations, help take all that thought process out. So if you've liked how I've traded, then you guys should take advantage of that. What are you saying there, Ted? Best wishes from a safe and happy 4th. What time should I be over for the steak? I'm going to be starting to grill steak out tomorrow around 1 o'clock. So head on over. How do you scan for high volatility ideas? Great question. You know what I do, KM? If you are on toss, I have this script that goes in here. You can create a column for it. So this is my scanner. There's no real way as of right now to scan for high implied volatility percent, but this is what I use specifically. And as a matter of fact, when I'm looking for high volatility trades, if I need to add some premium selling strategies, I just start at the top. I don't even look at what the stock is. I just say, hey, I've got a premium selling. I need to come up with something where I can sell some premiums. What look good, right? Or if I need to buy premium, I've got too many credit spreads in my account. I'm trying to add some premium buying strategies. Then I start at the bottom. I don't even look at the stock. I just start finding them. So that's how I scan for it, okay? So you can put the script over here. You can write to us and get it. We'll send it out to you. All right. So like I said, if you liked how I teach, you guys should take advantage of this offer for $297. I don't know when you would ever see this again. It's the first time I've seen it. So, or the first time we've offered it, I should say. So for $297, you get all of these different courses for a super low price. So you guys should take advantage of that. All right. That's all I got for you guys. Other than if you can't take that, take it easy. Take it easy, JQ. Take care, guys. Like I said, right now you're going to have to type this into the URL, but it is in the chat window for the correct link. Happy 4th, JQ. Happy 4th, KM. Take care, Banu. See you, Joe. Thanks, guys. Take care.